Yeah, struggled there. Tried to get back up to that all-time high that was made on earnings day. You got two highs within a nice area there for a $450 stock, 46.47 and 47.04. So nice double top there. You have to call it that. We are trading through the low of yesterday's session, 40.23. Pre-market low stands at 37 and a quarter. I'd have to say good support. A little bit lower than that. You had a couple lows. Well, they're not really three lows here. I see two lows, 33.24, 34.18. Another low at 33.69. So I flank that whole 33 area, 34 even. If you feel like you want to cover a short or look for support, I think it'd be see what kind of momentum you get on the downside. Did have a nice run. Could maybe in a little bit of a trading range. Don't think we're going to get back down to that major support, the 420 level. It is 8:35. We're going to bring on J.C. Parets. He's the founder of Eagle Bay Capital. He joins us every Thursday at 8:35 a.m. to discuss the markets. J.C., good morning to you. How you doing today?
I'm doing well. How's it going, guys?
We're doing good. We're got kind of an exciting day yesterday in the markets here. You got Mr. Icon moving the markets. JC, do you move stocks like that when you tweet?
I definitely don't. And getting back to the Carl Icahn thing, I just don't buy the fact that he comes out and says he doesn't like the market and the market sells off because of that. I don't buy it.
Yeah, but you got to buy. But Jason, okay, so he may not have sold out the overall market, but he did sell off Netflix because when he tweeted that, Netflix itself lost 20 points in about a minute. So you got to respect that he did put the top in Netflix there because he came out, said he had sold his Netflix position. Stock goes from 705 to 687 in like 30 seconds.
A name like that, full of momentum players, I don't doubt it for a second. That's a big deal, especially when you have such a big name, behind that. So you got a lot of people following that trade. I totally buy that. For the overall stock market to sell off, I don't know.
I agree. I agree with the overall market.
Again, I'd rather look at price than listen to what people have to say all day.
Okay, let's stick with the Netflix here. Look at price. Tell us what you're seeing here on Netflix. First of all, we announced the 7-for-1 stock split. Stock gets a nice lift early, pre-market, after hours. There's rallying up. Icon obviously put the damper on that rally. Starts to sell off. We got Citigroup actually coming out here today, downgrading the stocks, trading down another 5 points on this. But I know that doesn't matter to you, but price does matter to you, JC. What are you seeing on Netflix on your charts?
Well, we said it was going to 700. I've been saying that for the last $200 to $300.
Congratulations! Congratulations on that. That is an awesome call. Where does it go from here?
I don't know.
You're out. You're just out on this one.
It doesn't matter. It doesn't matter anymore.
Trade's
the
over.
Upside target. It's irrelevant now. I mean, where does it go? I don't know. I mean, it's one of those things. Like it hits the target, and now you just let it reevaluate. I mean, you don't have to trade. You don't have to get every 2% move in every single stock that trades out there. You have a well-defined setup. In this case, I thought it was pretty well-defined. I don't believe in triple tops. And going back to the 3 peaks last year, I just didn't buy that was a giant topping pattern. It looked more continuation in nature. And the upside objective based upon that was $700. And that was it. So now what happens? Now I have no idea. So if it crashes from here, great. If it consolidates from here and resets for another long, great. But that's something that we'll just have to reevaluate in the future.
Were you tempted or did you short it at 700?
No.
Okay.
I don't see any reason to short it. Just because your target there doesn't mean it's now short,
Okay.
Great point.
All right, let's move on to the overall market. I know you like to use the spider as a basis here in a trading range. We got up near the top of that range. Last couple days early this week, and whatever the reason was, Greece, Icon, whatever you want, we took it a little bit on the chin yesterday, trading up here in the pre-market. Talk to us about your SPY levels here, and I think you're going to say you don't think it's a triple top up here that we made in May, and we're going after those highs real soon.
We're still in that range. I mean, we talk about it every week, guys. I mean, we're still stuck in this range that we've been in all year, and
Yep.
there's I don't think there's any reason to fight it and be aggressive here. Do we ultimately break out? Maybe. You want to know what the easier trade is rather than looking at SPX. Look at the
Definitely.
Nasdaq 100. Look at the Nasdaq 100. That's the clean one. Look at the QQQ. If
Yeah.
you don't want to, if you, or the index, the NDX. You know, the S&P 500 and the Dow Jones Industrial Average for the large cap indexes, they're a little bit messy up there. You know, the highs aren't necessarily as clean as they are in the Nasdaq 100. Nasdaq 100 is the clean one, in my opinion. You got overhead supply just above 111, kissed it yesterday, the April highs, and quickly reversed. To me, this is the easier index to watch if you're going to trade the averages, which, you know, as we always talk about, you trade the averages, you get average returns. So it's not something that I really like doing, but something that we need to be conscious of, especially if you're putting on new long positions or you know, whatever the case may be. You know, so I'm one to definitely look at the averages. That's the clean level right there. I mean, a little bit above 111, going back to the late April highs in the Nasdaq 100. That's the one we want to clear. So if you want a cleaner level than what the S&Ps and the industrials are giving you, I think the Nasdaq 100 gives us a very, very clean level. I was joking yesterday. Remember Kid and Play, the guy with the flat top? Remember Kid and Play?
Yep. I remember
Yeah.
Kid
So
and Play.
I like my top like his hair. You know, not very flat up top. So it gives us a very clean level. And
Remember
I think
that
the
movie
Nasdaq
House
100
Party?
does that.
Wasn't his movie House
Yep.
Party? Do you remember that one, JC?
Exactly.
Kid and Play. Taking us back a few years. So JC here. Okay, so overall market here, obviously we're in trading range still. What are your, I know you're sitting there though, you've always got a good setup or two here. What's on your radar for today?
I mean, I hate to say it. I like the bonds, man. I really do.
Yeah?
I like the bonds. You know, you want to talk about clean levels. First of all, you know, I know it's only Thursday morning, so looking at weekly candles, you know, is not something that I like to do. But look at just keep it simple, you know, for the community. Look at TLT. Look at the candlestick in TLT 2 weeks ago. Look at the one last week, and look at the one that's forming now. You know, a lot of long shadows or wicks or whatever you want to call it, you know, mouse tails, you know, below those candlesticks the last 3 weeks. And then this one's shaping up in a very similar way, right near a 200-week moving average. So that I like for sure. And then if you look at a daily time frame, you know, again, you know, we want to use a top-down approach, you know, look at something a little bit more structurally, more longer term, and then work our way down, you know, into a more tactical sort of time frame. And you know, you've got a well-defined, you know, trend channel going back to December in TLTs. You know, going back to the highs in late January. You know, we are a few weeks ago we broke below that level, the lower of the two parallel trend lines, and quickly reversed. And we held that again this week. We've got some bullish momentum divergences. You know, I think TLT can probably see, you know, get back towards 123.
Yeah, interesting you bring up the 200-day moving average because a buddy of mine that trades a lot of bonds has been looking at as well. And I mean, you know, in stocks or, you know, bonds or whatever, you don't get too many shots at the 200-day moving average. And you know, it's a long-term indicator, and certainly it's coming into play here. I mean, if anything, you're looking at a lower risk trade here if you're entering at this level. You know, you know where your out is. Let's move on here and talk.
Yeah, that's exactly right. And just to touch on that real quick, I think it's actually the most important part. It's not where I think it's going. It's how well the risk is defined.
Yeah.
And those June lows from a few weeks ago, that's the 61.8% Fibonacci retracement of the entire 2014 rally. And the lower end of the trend channel on a more near-term basis. So I actually really do think that that's a big level.
JC,
So we only want to be long above that. We don't want to be long below that.
Right, you know where you're out. JC, you've been you haven't had much to say on Apple lately. It hit your upside target, 130 and changed. Pull back, not really giving you much of a pullback here. I think last week you were saying, you know, you felt there was a little more risk to the downside in Apple. Is that still your stance on the issue?
Well, it's not so much that I think we have downside risk. I mean, for me, it's more so the upside target was hit in February, and if you ignored those Fibonacci levels, you've been sitting in dead money, for now we're going on 4 months. I mean, you want to talk about opportunity cost. I mean, that gets expensive. So, we really take these Fibonacci extensions very seriously, particularly when they cluster together on multiple time frames like they did in this case. Sure enough, we've gone absolutely nowhere. I mean, if you ignored that, I don't know what to tell you. But now what I would argue is that, if this was a it's because it's consolidating in a very well-defined sort of, continuation pattern. This is a very traditional continuation pattern. And the problem is that it's taken way too long, in my opinion, for this to resolve to the upside. And, if this would have already resolved, a month ago or something like that, that would have been more symmetrical in nature. The markets have a certain symmetry to them, where trends tend to break out, in a timely manner within an ongoing uptrend. And in this case, man, it's taken way too long for my taste. And, I think that, in my experience, that decreases the likelihood that we get an upside break and probably increases the likelihood that it fails and breaks down. The problem with that is that when traditional bullish continuation patterns resolve in a negative fashion, that's bad. That's really, really, really bad. And not just Apple, it could be anything. We saw it in coffee in October. We've seen it all over the place. Johnson & Johnson back in January, we saw it. So, if that fails, that's really bad. So you want to know an interesting one to see? Look, and I was in San Francisco last week, and I was, talking with a potential investor of ours, and he brought this up, and I thought that he made an excellent point. If you look at Apple relative to the S&P 500, in other words, an Apple SPY ratio, we're seeing a very similar consolidation that we're seeing in the absolute Apple chart that we were just discussing, and that's a big one. I think that probably has bigger market implications as well. If we get an upside break in that particular ratio, we'll probably see it simultaneously in the absolute chart, and I think that would be great for not just Apple, but the market overall. I think that if that breaks down and resolves to the downside, I think that probably, says a lot about not just Apple, but about the market overall. And looking at some longer term charts, like I've mentioned to you before, kind of worry me a little bit. So for me, rather than looking to trade Apple, because right here I still think it's dead money, I'd be looking to see how this resolves more as an indicator for the overall market.
Oyster's making a point here. I just want to get your thoughts on this first. He's saying, can the Apple consolidation take longer, typically because its stock has split and there's so much more float out there now? Does that have anything to do? But we were looking actually from a consolidation because it had split before that and back at 100 and had the big move up here. But does the larger float have implications here to slow the stock down, JC?
I don't think so. I've never seen any data that suggests that at all. The market is fractal, so I don't buy that. Consolidation is going to take longer, and the market is going to be less symmetrical because they do a split. I mean, to me, that doesn't make any sense at all.
Yeah.
Splits. The only thing splits do is lower the price and allow individual investors to buy more shares, which to me adds zero value. And more importantly, we're already, in terms of these large cap stocks doing, large splits, more than 3-to-1 splits, kind of like what Netflix is doing. We've seen such a huge number of those extra large splits, and they're already in decline. And these sorts of things, very correlated with the S&P 500, and we're already declining. So, I think that the whole split situation is actually a negative for the market.
JC, I want to ask you about another stock that was in the news earlier this week. Ambarella, the components maker for GoPro phones, just had a parabolic move higher, and then Citron comes out, and it's really interesting. You had the delayed effect. It did get hit on that day, and then you gap lower, lost 20% of its value, and now, boy, that's not much of a bounce here, you would think, after that kind of shellacking here. Any take on Ambarella? AMBA.
Yeah, I wouldn't. I mean, I wouldn't touch this thing when you have a breakaway gap like that. It's such a severe move in such a quick time. It needs time to repair. I mean, these things don't necessarily come back so quickly. You know, you said you wanted a bigger bounce. That's just not normal. I mean, a bigger bounce to take it, that would be abnormal in my opinion. I think the fact that it's just kind of dead here, I think that's probably more to be expected than anything else. I would consider this to either be dead money or probably and more likely than not probably continue lower. You know, I could see this thing getting back under 80. I wouldn't surprise me one bit. I'm not shorting it, but I certainly would not be buying this. You know, if you're a day trader or something like that, you could find both long and short trades all day, and there's nothing wrong with that. But from a more intermediate term perspective, more looking past lunch, I think you could be patient with this one, or potentially looking to be putting on short trades. I can see this under 80 easily.
We've been on the line with J.C. Parets. He's the founder of Eagle Bay Capital, 10-year veteran of the markets, technician at heart. J.C., thanks for joining us as usual. We'll talk to you again next Thursday.
Thanks again for having me, guys. Go get them.
Thanks, J.C.